Hello, everyone, and welcome to the long overdue LePoidevin Group call that actually last time we spoke was actually back in March. So long overdue, 6 months. Lots happened, a lot hasn't happened. If you remember, the last call was titled Time for a Pause. We talked about the incredible run that we've had post the COVID lows. COVID may still be with us, but the stock market, of course, has had a tremendous recovery since then. So where are we since our last call, and where are we year to date? Let me just summarize where we are this year on the markets. We got the Dow up 13% as we speak. We got the S&P 500 US index up 18. We have the Toronto Stock Exchange up 18. Led by energy, ironically. We have the value line index, which measures all stocks unweighted in the US, up 15. We've got Europe up 15. We've got Asia down 5. And we got bonds about -3% for the year of total return. So let's talk for a second about what's happening in the markets. So I'm going to sort of say what's going on today, and then we'll go into where we think we're going forward. So I'm going to try and attempt to share my screen here. And are we sharing? Mark, good. Okay, so this is ironically the last 6 months. And I mentioned in the March call, is it time for a pause? So that was 6 months ago. And there's the S&P 500, which has actually had continued to march ever higher. Now I'm going to show you some other indexes, because the S&P 500 is 500 stocks, but it isn't all the stocks in the world. So if I talk in the past about the value line index, and the value line index measures an index of 3,700 stocks. So it's far more diversified, and it doesn't weight the mega stocks at the top any more than one of the ones near the bottom. So that really is representative of what the average guy is doing. And if you can see the value line index measuring all US stocks, it's actually about 0. So when we say time for a pause, that's kind of what a lot of my competitors' portfolios have looked like. There's the Russell 2000 index, which measures 2,000 companies in the United States, what they call small cap. We would call them mid cap, because those are kind of $1 to $20 billion companies. So we would call them even large, but in the United States, they call them small relative to a lot of those smaller ones. You can see that actually is down about 5% in the last 6 months. We can see there is Europe. As you know, we mentioned in the call, we like Europe a lot. Europe has done well in the last 6 months. And here's a market in the world, which is Asia, which we haven't liked, which has done horribly. In fact, from March to just a couple of weeks ago, there was a 20% decline in the Asia, and that's measured by the Asia ETF. China was even worse, as we don't want to get too much into it because we're not invested in there, but China is really socializing a lot of stocks, putting guys in jail if they make too much money. And Trudeau hasn't done that yet, but hasn't been good for stock investors in Asia. So I just wanted to talk for a second about what is going on. Why is the S&P 500 leading, and the value and the rest of the stocks kind of languishing in the last 6 months? Not that our portfolios have, but I'm just talking about indexes for the moment here. So if we look at these 6 stocks, Apple, Amazon, Alphabet, Microsoft, Netflix, and Tesla, these companies are in the S&P 500, but they make up, even though there are 6 companies there, they make up 19.5% of the index. We're hearing a lot of questions about the valuation of stocks. And a lot of people are telling me that the stock market is overvalued. Well, the average, and we're not even talking about current earnings, we're talking about projected earnings out a year or two, that my calculation shows that the average price to earnings multiple of these companies is 68 times earnings. So that is very, very high. Now, again, I'm going to throw some numbers at people. And I know some people have dialed in, which is why I also explain the graphs. I'm going to throw some numbers. And if you don't get all the numbers, that's okay, because I'm going to summarize the gist of it afterwards. But that's very, very high valuations. And these are valuations really not seen since the late 90s. And it's very interesting that as soon as you get kind of a hiccup, and you know, since we've spoken last, we've had this quote fourth wave, and people have gotten nervous about the recovery, nervous about investing, but they've gravitated to these very, very high valuation stocks, which everybody knows, listen, if we're locked up at home, Netflix is going to do very, very well. You know, Apple on your devices, Tesla, you know, again, the new technology, everybody's just loved to park there. But I went to, if you can remember the 1990s, the largest mutual fund in Canada was the Templeton Growth Fund. And I remember going to the annual meeting because it was actually set up as a corporation. So you could attend the annual meeting, and there was a speaker by the name of Marc Holowesco. And he showed a very, very powerful screen. And the screen was, you could buy Cisco systems, or you could buy, with the same amount of money, you could buy these host of this myriad of long list of stocks. And it was very, very powerful to me about the valuation. And the title of this slide says, what would you do with $750 billion? So for those of you who have $750 billion, you have a choice. You could buy all of Tesla. You could just buy all the stock. You could be the owner of Tesla. Now, I'm not sure Elon Musk would sell you the stocks, but hypothetically, these are the valuations of the company. You could also, with $750 billion, buy the entire companies of Canadian Natural Resources, Canada's biggest energy company, Teck Resources, one of the biggest base metal producers in the planet, Manulife Financial, Suncor, TC Energy, formerly known as TransCanada Pipe, Enbridge, Verizon, MetLife, Mosaic in the agricultural space, Intel, and General Motors. By the way, General Motors makes more profit than Tesla, yet trades at 1/10 the valuation. So you could buy these 11 companies, or you could buy Tesla. Of these companies, Tesla will earn about, and these are projected earnings, we're not even there yet, but Tesla will likely earn by next year about $4 billion in profits. With $750 billion, if you bought these 11 companies, you'd have $74 billion in earnings. Okay, so a multiple of, you know, what is that, 20 times more earning power, and you'd have no dividends with Tesla stock, and you'd have $24 billion of dividends every year from that list of companies that you could buy with $750 billion. Now, how do I unshare, stop sharing? Okay, there we go. So now you get to see my smiling face. You know, we hear a lot of questions have come in about valuations of the market. The S&P is projected in 2022 to earn about $2.20 of earnings. Now, these are earnings adjusted to the same pro rata portions of the 500 companies. So we normally talk about a company, it earns X amount of dollars. We're assuming that the 500 companies pro rata, divvy them up to the S&P 500 would be 220. The index is 4,400 today, which is a price earnings of 20, which is by the way, the danger zone. Okay, this is where 1987 crashed. These are valuations that a lot of people are asking the good question: is this way overpriced. Now, if we take out the 6 companies and we look at the earnings of the other 494, we've got a price earnings of 20. But if we take out the 6 companies that are at 68 times earnings and we take the other 80%, we see that the other 494 companies traded a valuation of 16 times earnings. Now, 16 times is actually the 50-year average valuation of stocks. I will also point out that listeners of the LePoidevin Group or my clients, when they speak to me one-on-one, they know that we always pose the question, money has to go somewhere. So if it has to go somewhere, let's remember that the average bond yield since 1950 is 6%. And the average yield on cash, meaning money market, treasury bills, is 5%. Today, we are still at 0 for cash, or maybe if you negotiate with the bank, you can get half of 1% if you have a large sum of money and you're a AAA customer. Bond yields, the 10-year government of Canada is at 1.18% today, 1.3% in the United States. And yet we have inflation readings in the United States of just over 5%. Not seen in 30 years, those inflation numbers. We have 3.7 in Canada. And so ironically, cash is getting actually more unappealing, because you could argue that a year ago there was no inflation when in the throes of the pandemic. Inflation was actually running at 0. And so 0 in cash made some logic. But today we go further and further into negative territory. Makes cash unappealing. So, in terms of cash going somewhere, it does have to find a home. Now, in the last 6 months, there's been some tremendous returns. Clients that have stuck with me in the preferred shares have worked out incredibly well. Our value stocks are doing, it's arguably the best year in my 37 years in the business, and so thank you for hanging in there. But where are we now and where do we go? Well, if money has to go somewhere, I would place my bets heavier on the good value stocks. And I want to sort of go back to why. If we go back to 1999, I picked 99 because if we remember when LePoidevin Group was back at National Bank, we have data that goes back in terms of rate of return. Now, RBC, we didn't have this data back then. That's 22 years ago. So we have data on client returns that go back about 22 years. And if you came into the office in September of 1999 and you put $1 million into the S&P 500, the S&P 500 was 2,400 in 1999, and it's 4,400 today. So that's exactly 100%. But including dividends, if you gave us $1 million and you said, what's the value today? It would be about $3.7 million, including dividends and dividend reinvestment. Well, if you actually invested with the LePoidevin Group with that same $1 million and you paid fees and you listened to our conference calls where would we stand today? And the actual answer is 8.2 million. So we have done twice the return in the S&P 500. And there's really 3 events that really differentiate. And one is back in the late 90s when interest rates were very, very low, technology shares at very, very high valuations continued to go on a parabolic level upwards. And we didn't play in that field. We own no Cisco, we own no Nortel in our portfolios. And we know no JDS, Uniphase, all the big companies back then. We preferred bonds and we preferred good value stocks. And that stood us very, very well. And going forward, it's very dangerous. We don't want to play the game of musical chairs of owning these high value stocks that with 0 rates, young people are throwing money at it and they're taking their government checks and they're putting it into the market. But eventually interest rates are going to go up, and that might be sooner rather than later. Might be as early as next year. In fact, that's our prediction. So in a nutshell, that kind of says where we've been and why we're positioned where we are. Let me talk about going forward. The overwhelming amount of questions we had were, what about the upcoming correction? We had one, there's going to be a correction in October. Another person said, I heard there's going to be one in November. And I say, well, actually, we don't really have the conditions that precede a correction. Those conditions need to be that the sentiment amongst the investors has gotten overly frothy, and in other words, there's too many people in the market, and if there's money has to go somewhere, if everybody's in, there's no fuel left to make it go higher. But those sentiment readings are very, very cautious at this point, with the average individual investors are just 40% bullish and 30% bearish, approximately. And those are numbers that we need to see about 60% of the investing public bullish and only 20% bearish, typically, to see a correction. Now, I will caution you, doing a little homework on corrections. Since 1980, there have been 39 corrections. So in 40 years, we've had 39 corrections of over 10%. We've had 5 recessions, okay? So 34 of those corrections had nothing to do with the economic cycle, or they were just wrong. We talked about avoiding the tech bubble of the late 90s, which is one reason we've outperformed by a large margin. The other reason is that we did get the conditions right in 2001 and 2000. We did get the conditions right in 2007 for a typical economic cycle. And those conditions are that the US Federal Reserve has raised rates a series of times, and every recession in US history is preceded by a rise in interest rates. By the way, including the COVID recession. Now, rates were going up, but they hadn't gone up enough to create a true liquidity, foreclosing on homes, businesses failing. And that's why it was just a lockdown recession, which is what we talked about last year and why we stayed in the market. So, you know, what is going to derail this market? Because the market is not going to go up forever. And the answer is that we will generally stay invested until such time that the Federal Reserve really starts to fight inflation and raise rates. Now, inflation has been going up, and it's amazing that the US uses this word transitory. And they've done a fantastic job in convincing people that the 5% inflation rate that we see is nothing more than shortages due to COVID. It's a chip shortage, it's a lumber shortage, it's all kinds of shortages which are temporary, and inflation will come down. I don't want to throw the chart in again because I've thrown it in a number of times, but the money supply is the root cause of inflation, and money supply has been growing. There's about over 30% more dollars being watered down, and that means our money is worth less, not worthless, worth less than it was because there's more of it. Productivity, we're not producing 30% more, so that means over time that our money is not as valuable. If you remember the late 1990s, the Fed wasn't raising rates because they were worried about Y2K. And they were worried that, if you could remember back then, all the computers were going to stop and planes were going to fall out of the sky as the computers weren't adopt to go to 4 digits, and they were going to revert back to 1900. That never happened, but the Fed really didn't start raising rates until after Y2K, which is why the market peaked in early 2000. The Fed would normally be raising rates right now. But my theory is the Fed is not raising rates despite the fact that they should, because COVID is still a problem well, it's still a problem in North America, but it's a big problem in Asia, whereas we know that Japan had no spectators. They have very, very low vaccination rates. And so when the US starts raising rates, they set the tone for the world. And if rates start going higher in the United States, if you can remember in the late 90s, the Thai baht crisis led to the Asian flu, almost all the Asian currencies blew up. The Russian ruble in 1999 defaulted. If you can remember the 07-08, we had the European crisis. We had Iceland devalue their currency by 80%. If US starts raising rates, someone will blow up. And with COVID, they can't afford it. So what I think is happening is we have another reprieve to make some money going forward. Okay, and that is when I hear people say there's a correction, that means people are flooding out of stocks into cash. The real yield of US cash is -5. There's a penalty. It's never been, cash is so unappealing. So even when you see headlines and the markets fall for 2 days or a week, it's not sticky. It can't stick in cash. So the end of this run becomes when the Fed really starts to back up and raise rates. And it typically isn't the first rate rise. There's an old saying, 3 steps and a stumble. We are a long, long ways away from US raising rates 3 times. So the long and the short of it is there's very, very good value in a lot of the sectors of the market. You know, it's interesting, we talk about energy being the best performing sector in the planet this year, and yet nobody's excited about it. Nobody's talking about it. Canadian Natural Resources still trades at only 8 times earnings because everybody knows it's such a lousy long-term resource. But that being said, if you owned all of Canadian Natural Resources, it's got a cap rate of 12%. You're making 12% on your money. And that's with $70 oil. If I'm right, and oil is actually going higher from all this money supply growth, you're going to make even more than 12% on your money on a year-over-year basis, which means that the stock price is grossly undervalued. So, you know, we'll keep it diversified. There is, as I said, lots of value in a lot of places. The preferred shares are very, very interesting still, and we've done extremely well in them. And what we find really interesting today is not the ones that are trading already at their par value, and those are the fixed ones that were, say, Great West, were yielding 4.5, and we bought them at $20, people, and so at 25.5, we're selling those. But the Bell Canada floaters are floating with prime. You can still buy them at $18, which means you're getting 125% of prime. It's very, very appealing at the price that it is today. If rates go up at the end of 2022, these things are going to go higher. Let's remember when rates were just 2% or 2.5%, these preferreds traded at par value. So that's where I think they're going. And so we still have a 30% potential rise in price, as well as collecting some fantastic dividends. So there's lots of places to go other than cash at this time. And I can't tell you when we're going to get negative on stocks, because only one person knows that, and that's Jerome Powell of the United States. And, you know, I don't talk about the Bank of Canada because Bank of Canada follows the United States. I will briefly comment on the election, and that is that the markets will not care unless the NDP sweep or the Greens sweep to a majority, and that'll be a disaster from an investment standpoint. I don't know which way everybody tilts, left or right. But I will also tell you that it doesn't matter the day after the election and a week after the election, not even a month, but it does matter long term. And if we go down the path of these deficits and we're going to make Canada better and we're going to tax, we're going to go down a path that is going to be hard to reverse, which is debt does matter. And if you're as old as I am, you can remember that it took a long, long time to wrestle down the deficits of Pierre Trudeau, who was nationalist and well-liked, and some people call him the greatest prime minister in Canadian history, but he was an economic disaster in that these deficits and the social spending were out of control. And it took Brian Mulroney, Stephen Harper, Jean Chrétien, Paul Martin. It took a series of both liberals and conservatives to wrestle that debt down. And now we're going back down that path. So we're out there a ways down the road, but I can tell you a deficit matters. And at some point, the bigger the deficit, the higher interest rate you have to pay, because bonds are still subject to the laws of supply and demand. A deficit is issuing a bond. And if you can remember 1981, the government, Pierre Trudeau, went to issue bonds at 17 3/4, and there were no buyers. In an emergency, they had to issue savings bonds at 19.5. The government ran out of money. And I hear a lot of people, they won't let interest rates go up. Well, Pierre Trudeau would love to have borrowed at 0% or 1%. There were no buyers at 17 3/4. So eventually, unfortunately, there's an entire generation that doesn't understand deficits. So they're voting for green initiatives and social policies. But, you know, even, it's a dirty word to talk about the deficits. Even the conservatives don't really talk about it. They go, well, 10 years will balance. So we may be going down the wrong path no matter who wins. It'll get there quicker if the progressives are in power than if the conservatives are in power. But we shall see. Again, I don't think it makes it any difference to our portfolios in the next few months. So that kind of wraps up what I wanted to say. Marc's going to go through some questions, and once again, if I haven't covered what you were hoping I would cover, please feel free to contact us, set up a call or emails, and we'll go from there.
So we got a whole bunch of questions, only enough time to go through a few of them. So if something doesn't get answered, you know, get in touch with us. But I tried to focus on some of the questions that had multiple different variations, and we'll tackle some of those. So first question, got a lot on this particular topic, which was cryptocurrencies. You know, I won't read them verbatim, but to paraphrase, you know, how does it fit into a potential portfolio? So for us, the short answer is they don't. If you've been a client of ours long enough, you've heard us use the word asymmetric risk. You know, looking for investment opportunities where the potential for reward and risk, there's an imbalance there. We want, you know, higher reward with lower risk. And for us, you know, for the time being, the crypto markets don't really satisfy that test. So they have a relatively short history as an asset class, but a fairly long history of booms and busts. The volatility daily is high. I think the vast majority of participants don't have a great understanding, and I think it's mostly speculation on the basis of, you know, what they own, they'll be able to sell to somebody at a higher price in the future. So for us and our clients, we'll watch it from the sidelines for now. Next question was, is there a practical means to establish a hedge in the portfolio against a 10% correction? If so, what instrument would be used to hedge and how much? David talked a little bit about corrections generally. You know, we don't go to great lengths to create hedges and accounts for corrections. They happen sometimes for reasons, you know, that don't make a whole heck of a lot of sense, but they happen and they're normal. You know, we may raise some cash ahead of time if we see some warning signs. We may not allocate cash if we see some warning signs. Now, there are conditions sometimes that come into play where it warrants creating hedges. Clients of our group that were back in 2007 know full well that we were putting on some put options ahead of 2008, which obviously served us very well. So, you know, put options give you the right to sell a security or an index in the future at a certain price. If markets fall, you've got a contract that's, you know, going to be worth more if you could sell it for more. So, you know, those are some things that we may do. Put options are a lot like fire insurance on your house. You know, If you're trying to do it when it's raining out and there's no fires around, then you're going to pay a much lower premium. If you're trying to do it right when the pandemic hits and the fires are blazing around your house, you're going to pay a much higher premium. So there are things we can do, and there are conditions that warrant it, but corrections typically, aren't those. Okay, so we'll go with one more here. It says Marc and David often make reference to investor sentiment as a way to gauge market direction. How is this done? And what is it saying today? So, David talked about sentiment. I won't go into it in too much more detail, but clients of ours know that investor sentiment is near and dear to our investment heart as something to track and follow. Our favored sentiment indicator is through the American Association of Individual Investors, which polls its membership and asks them where they believe the market will be 6 months from now. So it works especially well at extremes. For example, March of 2009, it reported just 18% bulls and over 70% bears. And I think with the benefit of hindsight, we can all agree that March of 2009 was a decent entry point for stocks. And even last year, heading into the fall, we had no approved vaccines. We had an election coming up. Was it going to be Donald Trump? Was it going to be a blue wave? That created a lot more nervousness, and we had a reporting of only 38% or 23% bulls and 50% bears. And again, with the benefit of hindsight, that was a great entry point. So right now, David just talked about it. The sentiment numbers are looking pretty good. They're sort of in the middle. They're close to averages. And so it's just something we follow. And when it gets to extremes, we use it as a pretty good tool.
Yeah, just to talk about corrections for a moment. Corrections happen when they're least expected. There's so much anticipation of the upcoming correction that it doesn't, I wouldn't do a lot to portfolios because we're not talking about an imminent recession, and we're talking about money piled in cash that doesn't want to be there. So it wouldn't be a long-term thing. But it also, creates a lot of tax liability to try to flip in and flip out of the markets. I will tell you that, a successful investment program is actually just sticking the course. One of the things that we have to deal with in Marc and I and Darcy and Fletcher, we've got to deal with questions when we've had one of these corrections. And I'll tell you an interesting stat, which is that 87% of the time in the stock market, we are not at a new all-time high. Okay, so 87% of the time, we are down more than 2% from some number that we were at a month ago or 2 months ago or 3 months ago. So if we look at our portfolios and we say, I knew it, I've gone from 500,000 to 460, I knew it. 87% of the time we're not going to be at a record level, and 13% of the time we are. But our plan is to, whatever the record is, and if today's a record, so be it, is that in 6 months from now to make sure we're at a new record of the record. And we look at the sawtooth and a saw on a direction of the bottom left-hand corner of the page to the upper right-hand corner of the page, and that's our goal. I find that people that are so paranoid about corrections, they're never in. And most of the time they're happy because their friends are down from some number. Our clients have made a lot of money, and let's look at it on a year-over-year basis. I mean, the correction of last year was incredible, and yet I was looking at some accounts from January 1st, 2020. We've never heard of the word COVID, and I mean, it's been not from the bottom. I mean, of course we're way up from the bottom, but if you look at pre-COVID, the benefit of all this money printing has been that our accounts have had an exceptional time, and let's stay with it. I will, for the people that are nervous, the most difficult year in the stock market in the presidential cycle, there's a 4-year cycle, is the second year of a presidential term. So let's remember the second year of Donald Trump. First year was 2017, second year 2018. It was a difficult year in the markets. I mean, we didn't get crushed, but we didn't make any money. We're down to 1 or 2% for the year, and it was difficult. And you know, we'll see what happens next year. If rates stayed zero for the year, we will be very, very pleased, and we will get prepared. So typically, so stay tuned. It's the spring of the second year where you start to look. Now, again, I'm jumping the gun, but that gives us another window of 6 to 8 months of making some real good money before we sort of play for this correction. The average correction, I've talked about 39, is 16.5%. And again, of those corrections, 34% of them they all go down for some reason. Were ill-timed and ill-advised to be playing in those corrections. So, you know, most of the time, let's not worry about the weekly ups and downs of the market. Let's get the trend right. Let's get the year right. Marc, anything else to add?
Nope. Sounds good.
Okay, thanks everyone. We'll wrap it up. That's about as much time as I've been allocated. Thanks.